Hello, today we're going to be going over the different methods to account for equity investments. First, we have the fair value method. A company can choose to use the fair value or not and has to stick with its choice. Unrealized holding gains and losses are recorded to the income statement. Then, when a company sells a bond, it becomes realized. Usually, investors have a few shares in the investee's company, and due to the limited ownership, the investor cannot expect to have big control of decision-making or operations. Next, we have the cost method for equity securities without readily determinable fair values. First, the cost method equity investment must be assessed for impairment to determine the carry value is less than the carrying amount. Second, any unrealized holding gains or losses from those price changes are recorded as corresponding adjustments to the investment account. This means if equity shares are only infrequently traded and fair value is not readily determinable, those trades can provide financial statement recognition under the cost method for equity investment. Next, we have the consolidation of financial statements. If a parent company has controlling interest of more than 50% in the subsidiary, then the consolidation accounting is applied. This means all subsidiary companies' assets, liabilities, revenues, and expenses are combined into the parent company's financial statement. Lastly, we have the equity method. The equity method is used in accounting for investments in associate companies. This is generally applied when a company owns 20 to 50% of the voting stock of an associate company because it has significant influence. Now we're going to go over some journal entries. First, we have the journal entries if an investor uses the fair value method. First, when the investor records the investment in the investee at cost, there is a debit to investment and a credit to cash. Second, when the investor recognizes dividend income for cash dividends received from the investee, there is a debit to cash and a credit to income from investee. Finally, there is a debit to investment and a credit to unrealized gain when the investor adjusts in the investment account to fair value market. Now we're going to go over the journal entries if an investor uses the equity method. First, debit the investment account and credit equity in investee income. This entry is to record the investor's accrued income from the investee's reported earnings based on the investor's ownership percentage. Next, debit dividend receivable and credit investment account to record a dividend declaration by the investee. Lastly, when the investor collects the dividend from the investee, debit cash and credit dividend receivable. I hope this helps. Thank you for watching.